Welcome, curious minds, to the deep dive. We're about to peel back the layers on a global giant, PepsiCo, and figure out what's really happening behind the scenes.
Yeah, there's definitely a story there.
There is. And here's a surprising fact to kick us off. For the 12 weeks ended June 14, 2025, PepsiCo's net revenue stayed largely flat, pretty stable.
Mm-hmm.
Yet their operating profit plummeted by a shocking 56%.
56%. That's quite a gap.
It really is. That kind of stark contrast,
Right.
stable sales, but a massive profit dip. It just demands a closer look.
It absolutely does. It suggests some pretty powerful forces are at play beneath the surface, doesn't it?
And that's exactly what we're going to unpack today. Our mission on this deep dive is basically to shortcut you straight to the most important insights, the surprising facts from PepsiCo's latest financial filing.
That's their quarterly report on Form 10Q for the period ended June 14th, 2025.
Right. And for those of you who don't spend your days, poring over these documents, a Form 10Q, it's a mandatory quarterly financial report. All public companies like PepsiCo file them with the SEC.
And it gives a really detailed look, no holds barred, at their performance, financial health, the risks they're facing, everything.
Exactly. So our goal is to make you instantly well-informed about one of the biggest consumer giants on the planet, without you having to wade through hundreds of pages yourself.
Think of it as getting the crucial intelligence on PepsiCo's health, understanding not just what happened, but why it matters and what it signals for the broader consumer landscape.
Okay, let's dive into the big picture then. Top-line financials. You might expect a company of PepsiCo's scale, maybe see huge revenue swings, but surprisingly, their net revenue was quite stable.
Yeah, remarkably steady at the top.
For the 12 weeks ending June 14, 2025, they reported $22,726 million. That's just a slight bump from $22,501 million last year.
Barely moved.
And over the 24-week period, essentially flat. $40,645 million this year compared to $40,751 million in the prior year. Very, very close.
Right. But what's truly fascinating here, as you hinted, is that while revenue held steady, the profit picture is, well, dramatically different.
Dramatically is the word.
For the 12 weeks, operating profit fell by a staggering 56%, down to $1,789 million from over $4 billion, $4,048 million last year.
Wow.
And for the 24 weeks, it was down 35%, from $6,765 million down to $4,372 million.
That's a huge drop. And it wasn't just operating profit, was it?
No, not at all. Net income attributable to PepsiCo plunged 59% for the 12 weeks.
59%.
And 40% for the 24 ones. Diluted earnings per share followed suit, dropping 59% and 39% respectively.
So the critical question, as you just alluded to, is just what caused such a profound dive in their profitability when sales were holding up?
That is indeed the key question. And the primary driver, the biggest factor behind this significant profit decline was a pre-tax impairment charge, a big one, $1,860 million.
Okay, $1.86 billion. What does that mean in plain English? An impairment charge.
Right. So to simplify it, it means PepsiCo had to admit that the value they had on their books for certain assets, specifically intangible assets like brand names, well, that value was determined to be higher than their actual current fair value.
So they're basically saying, this brand isn't worth what we thought it was or what we were carrying it at.
Exactly. It's an acknowledgement that future expectations for those brands have been lowered.
So this isn't just some accounting adjustment. It's PepsiCo essentially admitting these brands aren't meeting their growth expectations anymore. Which brands took the hit here?
The largest portion of that charge, $1,780 million of it, was primarily related to the Rockstar energy drink brand.
Yeah, sorry.
And this impacted their PepsiCo Beverages North America, PBNA, and their Europe, Middle East, and Africa, or EMEA segments.
Right.
There was also a smaller $80 million impairment related to the Bianchiri brand in their Asia Pacific Foods segment.
That's a staggering hit on Rockstar, though. It really indicates maybe not just a financial correction, but a fundamental reevaluation of what PepsiCo believes are its future growth drivers, especially in energy drinks and maybe certain snack markets.
Yeah, I think that's fair. It signifies a few things. First, as we said, the value they were carrying for these brands exceeded their fair value because they had to lower their estimates for future business performance compared to what they originally projected.
Right.
Second, there was an increase in their weighted average cost of capital.
Which is like their internal hurdle rate for investments.
Exactly. If that rate goes up, future projections naturally look less favorable when you discount them back. Now, beyond these major impairment charges, there were other factors contributing to the profit decline, too.
Right, it's rarely just one thing.
No. You had general operating cost increases, spending on strategic initiatives, and also a decline in organic volume.
Meaning they actually sold less stuff.
Correct. Fewer units moved.
So it sounds like even a giant like PepsiCo isn't immune to, well, the grocery bill shock we all feel just on a massive global scale.
They certainly aren't. Higher commodity costs were a definite hit. They impacted operating profit by 5 percentage points for the 12 weeks and 4 percentage points for the 24 weeks.
Ouch.
Yeah. And there were also increased restructuring charges. Now, on the flip side, they did see some partial offsets.
Okay, some good news.
Some productivity savings helped, and also effective net pricing.
Which means they raised prices or managed their product mix well, sold more expensive stuff.
Precisely.
Yeah.
But those positives just couldn't overcome the sheer size of the impairments and those other cost pressures.
It's fascinating how the impairments really stand out, especially across specific segments, as the main reason for the profit drop, even while some regions might have actually grown volume.
Absolutely.
It's almost like PepsiCo is managing several distinct businesses under one roof, right? Each with its own set of challenges and sometimes triumphs.
That's a great way to put it.
So let's zoom in then. Let's look at how this played out across their different segments, because like you said, it's definitely not a uniform story.
Indeed. Each segment gives us a piece of the puzzle. Let's start with PepsiCo Foods North America, or PFNA.
Okay, North American foods.
Their net revenue actually increased by 1% for the 12 weeks. Though it slightly decreased for the 24 weeks, this was largely boosted by acquisitions they made.
Right, like Cedo Foods.
Hmm.
And how did their volume trends look, particularly in savory snacks, their core area?
Well, their savory snacks volume, think chips and things, declined by about 2 to 3%.
Okay.
But their other foods saw a pretty healthy increase, about 5 to 7%. However, their operating profit, that was down 17% for the 12 weeks and 8% for the 24 weeks.
So even with some volume growth in parts and acquisition help, profits still fell. Why?
It came down to those operating cost increases we mentioned, spending on strategic initiatives, and that overall volume decrease in savory, although productivity savings did provide a partial offset.
Okay. So after looking at PFNA, the real drama seems to unfold in PepsiCo Beverages North America, PBNA. This is where we saw that massive profit decline you mentioned.
Yeah, this is where the numbers get pretty wild.
Can you walk us through the main factors there, especially the impact of that Rockstar impairment?
Sure. This segment saw the most dramatic impact by far. Net revenue slightly decreased for both the 12 and 24-week periods. That was due to a decline in organic volume and also the impact of acquisitions and divestitures.
How did the volumes break down, like soda versus other drinks?
Their non-carbonated beverages, think juices, water, teas, declined 6% in volume,
Oof.
while carbonated soft drinks, CSDs, saw a slight 1% increase. So a bit of a mixed bag there. But here's where it gets really eye-opening. Operating profit in PBNA saw a staggering 165% decrease for the 12 weeks.
Whoa, wait. 165% decrease? How is that even possible? Does that mean they lost money?
It means their profit didn't just fall, it swung dramatically into negative territory compared to the profit they made last year. For the 24 weeks, it was down 112%.
That percentage drop is just astonishing. So it wasn't just soft drink sales being a bit weak, it was this huge reevaluation of Rockstar's future value, absolutely crushing the segment's bottom line.
Precisely. That Rockstar brand impairment was the primary driver. It was also impacted by higher operating costs, the volume decline, and some acquisition-related charges from their Poppy acquisition we'll talk about later.
Okay.
Though, again, effective net pricing and productivity savings did offer some small relief, but nowhere near enough to offset that impairment.
Wow. Okay, moving on from that drama, what about the International Beverages franchise? How did they fare?
A bit of a calmer story there. They saw net revenue increase by 3% for both the 12 and 24-week periods.
Okay, steady growth.
And volume grew too, by 1% and 2% respectively. This was driven by growth in places like the Middle East, China, and Pakistan, although they did see a decline in India for the 12-week period.
And what about their profit picture in this international franchise segment? Was it positive?
Yes, operating profit for IB franchise increased by 7% for the 12 weeks and 6% for the 24 weeks.
So, pretty good story there.
Yeah, fueled by that revenue growth and actually lower advertising costs. It was partially offset by a prior year gain on an investment disposal that didn't repeat, and again, higher commodity costs, but overall positive.
Good. Okay, from the International Beverages franchise, let's shift our focus to Europe, Middle East, and Africa, or EMEA. Big, diverse region. What's the picture looking like there?
Right, EMEA. Their net revenue increased, actually, up 8% for the 12 weeks and 5% for the 24 weeks. So top line looked okay.
But. I sense a but.
But yeah, convenient foods volume declined by 6 to 7%, particularly in South Africa, Russia, the Middle East, and the UK.
Okay.
Beverages saw mixed results, grew 1% for the 12 weeks, but then declined 1% for the 24 weeks overall. There was growth in places like Turkey, Poland, Germany, the Middle East, and France, though.
And the profit, given the impairment discussion.
Yeah, their operating profit also decreased significantly. It was down 36% for the 12 weeks and 26% for the 24 weeks.
Was the Rockstar impairment a factor here too then, contributing to that profit dip?
Yes, absolutely. The Rockstar impairment hit this segment as well. That, alongside general operating cost increases and really significant commodity cost increases.
What kind of commodities hit them hardest there?
Primarily dairy, potatoes, and cooking oil or packaging. Those impacted profit by a hefty 26% and 30% in the two periods, respectively. Big impact.
Okay. Shifting again, let's go to Latin America foods.
Yeah.
What do the numbers reveal there? Especially thinking about currency fluctuations, which are always such a big part of that region story.
You nailed it. Latin America foods saw net revenue decrease by 7% for the 12 weeks and 9% for the 24 weeks.
Okay, so revenue down.
The primary reason for this was a huge 14 percentage point negative impact from unfavorable foreign exchange translation, especially the weakening Mexican peso.
Ah, so if you take out the currency effect, the underlying business.
The underlying volume actually grew, up 4% for the 12 weeks and 2% for the 24 weeks, with broad-based increases led by Brazil. Pretty resilient.
But the profit still took a hit.
It did. Operating profit decreased slightly for the 12 weeks, about 1%, and down 8% for the 24 weeks. Again, mainly due to that FX impact and higher commodity costs, although productivity savings and some indirect tax credits in Brazil helped soften the blow a bit.
Okay, makes sense. Finally, let's look at Asia-Pacific foods. What happened there?
Asia-Pacific Foods, or APF. Net revenue was basically flat, up 0.5% for the 12 weeks, but decreased 1% for the 24 weeks. This was impacted by unfavorable net pricing.
But volume.
Volume grew nicely, up 5% for the 12 weeks and 4% for the 24 weeks, with growth in India, Thailand, Australia, and China.
Okay, so decent volume growth, but what about the profit? I remember an impairment mentioned here too.
Yeah, this is another segment with a sharp profit drop. Operating profit here plummeted 90% for the 12 weeks and 39% for the 24 weeks. This was primarily due to that Bianchiri brand impairment we mentioned earlier.
Right, the $80 million one.
Exactly. That, plus the unfavorable net pricing and operating cost increases, really hit the bottom line hard in APF.
Wow. Okay, so having unpacked where the challenges lie across all these different segments, let's pivot now to how PepsiCo is actively trying to shape its future, even with these headwinds. What strategic moves are they making? What are they doing with their capital right now?
Right. This is where we see the company actively, playing offense, even amidst the current challenges. They made two key acquisitions this period that really stand out.
Acquisitions. Okay, which key brands did they bring into the portfolio during this reporting period?
First, on January 17th, 2025, PepsiCo acquired Siet Family Foods. That's a Mexican-American foods business. They paid $1.2 billion in cash.
Siete. Okay, I know them. Grain-free tortillas, chips.
That's the one. They integrated that into their PF&A segment, North American Foods.
Makes sense. And the second?
Then on May 19th, 2025, they acquired Poppi. That's the prebiotic soda business that's been growing like crazy.
Poppi, yes, seeing that everywhere. How much for that one?
That was $1.95 billion in cash, plus there's another potential $0.2 billion in contingent consideration based on future performance.
Big bet on functional beverages there.
Definitely. And that one was integrated into the PD&A segment, North American Beverages. Together, these two acquisitions alone contributed almost $1 billion, $919 million, to the increase in goodwill on their balance sheet.
So interesting dynamic. They're writing down the value of an established brand like Rockstar, but spending big bucks to acquire newer, potentially high-growth brands like Siet and Poppi.
Exactly. It shows a real portfolio shift, trying to capture emerging trends.
What else are they doing strategically with their resources for the longer term? Anything on the efficiency front?
Yes, they've also expanded their existing 2019 productivity plan. They've actually extended it all the way out to the end of 2030.
Okay, what's the goal of that plan?
It's all about leveraging new technology, different business models to simplify things, harmonize processes across the globe, and automate where possible. Basically become more efficient.
Sounds expensive up front, though.
It is. They expect to incur approximately $6.15 billion in pre-tax charges related to this plan, with about $5.1 billion of that being actual cash expenditures by the end of 2030.
And how far along are they?
As of June 14, 2025, they've already incurred $3.1 billion in those pre-tax charges and spent $2.3 billion in cash. They expect the majority of the remaining costs to hit by 2027. So they're deep into it.
That's a huge long-term investment in streamlining their operations.
Yeah.
How are these kinds of strategic moves, the big acquisitions, the productivity spending, how are they impacting their cash flow? Especially given the lower operating profit we talked about earlier.
Right. Their cash flow dynamics definitely reflect these shifts. Net cash provided by operating activities, the cash generated from the core business actually decreased. It was $1.0 billion for the first 24 weeks of 2025, down from $1.3 billion in the same period last year.
And that directly reflects that lower operating profit.
Directly. Less profit coming in means less cash from operations. Conversely, net cash used for investing activities shot up significantly.
Because of the acquisition.
Exactly. They used $4.1 billion for investing activities in the 24 weeks, compared to just $1.4 billion last year. That increase was largely driven by paying for C8 and Poppy.
Okay, that makes sense. Spending more on buying new assets.
Mhm.
And what about the financing side of things? How did they fund all this?
That's where things shifted quite a bit. Net cash provided by financing activities was $1.9 billion for the 24 weeks this year. That's a notable swing from the prior year period, where they actually used $2.9 billion in financing activities.
So cash came in from financing this year. How?
Primarily through debt. They had significant proceeds from issuing long-term debt, about $3.5 billion, and also from short-term borrowings, around $5.2 billion.
Okay, so they borrowed quite a bit.
They did, and these proceeds helped offset the cash going out for dividends. They paid out $3.743 billion, and also for share repurchases, which were about $494 million.
Speaking of dividends, what about shareholder returns overall? Are they still prioritizing paying shareholders even with this hit to profit and all the spending?
Absolutely. That seems to remain a key priority. PepsiCo actually increased its annualized dividend by 5% to $5.69 per share, effective in June 2025.
Okay, a dividend hike.
Yeah. And they expect to return approximately $8.6 billion to shareholders in total for 2025. That's made up of about $7.6 billion in dividends and $1.0 billion in share repurchases.
But wait, if operating cash flow is down and they're spending billions on acquisitions and still paying out billions in dividends and buybacks, how does the math work? You mentioned free cash flow.
Right, and that's the crucial point here. Their free cash flow, which is basically operating cash flow minus capital spending, plus any proceeds from selling property, was actually negative $342 million for the 24 weeks.
Negative free cash flow. So what does that tell us? How are they managing these acquisitions and shareholder returns then?
Think of it like this. For this period, the cash generated by the business itself wasn't enough to cover their investments, like CapEx and acquisitions, and their shareholder returns.
So they're borrowing to bridge the gap.
Essentially, yes. It indicates that, for this period at least, those acquisitions and shareholder returns are being financed through other means, primarily through that increased debt issuance we just talked about. It's a common strategy, especially when companies see growth opportunities, but it definitely puts the spotlight on their need for stronger operational cash flow down the line to support it all.
That's a really critical insight. Okay, speaking of challenges and things to watch, what are the big headwinds PepsiCo is navigating beyond the immediate financials? What risks are they flagging?
Well, one that keeps coming up is foreign exchange volatility. Currency
Huh.
swings.
Always a factor for global companies.
Always. Unfavorable foreign exchange impacts reduced their net revenue performance by 1.5 percentage points for the 12 weeks and 2 percentage points for the 24 weeks.
Which currencies were the main culprits?
Primarily declines in the Mexican peso, the Turkish lira, and the Brazilian real. Although, interestingly, the appreciation of the Russian ruble did partially offset some of this.
And their international footprint is massive, right? So that exposure is always going to be a risk, particularly with unpredictable geopolitical conditions.
Indeed. About 41% of their consolidated net revenue comes from outside North America. And Russia, for instance, remains a significant market. It accounted for 5% of consolidated net revenue for the 12 weeks, and they actually hold 17% of PepsiCo's total consolidated cash and cash equivalents in Russia.
Wow, 17% of their cash is in Russia.
As of the report date, yes. So volatile geopolitical conditions are definitely a constant concern they have to manage.
Plus, we're all still seeing commodity prices bouncing around. That must be a headache.
Absolutely, those volatile geopolitical conditions feed into it, but also inflation, import-export restrictions, tariffs, crazy weather patterns, supply chain disruptions, all these continue to impact their costs for commodities, transportation, and labor. It's an ongoing battle.
And what about the regulatory and tax environment? Anything changing there?
Yes, that's another area they're watching closely. New or increased taxes and regulations on their products or packaging are being imposed or considered in various places.
Like those sugar taxes we hear about, or rules around plastics.
Precisely. Things like sugar taxes, new plastic regulations, or even taxes on specific snack ingredients like sugar, sodium, or fat. Those are popping up globally.
Any big international tax changes?
Well, the OECD global minimum tax rate of 15% is expected to be widely implemented by the end of 2025. That could definitely increase their overall tax burden.
And any U.S. tax changes impacting them?
They mentioned they're also assessing the tax reform provisions of the recently signed U.S. legislation, the One Big Beautiful Bill Act, I think it was called, looking at how its changes to corporate tax structures and incentives might affect them.
Okay. And are they facing any major legal battles right now?
They mentioned a couple. PepsiCo is facing lawsuits in Los Angeles County and also in the U.S. Virgin Islands. These allege things like public nuisance and deceptive practices related to plastic pollution.
Plastic pollution lawsuits. Okay. How serious do they think those are?
Their management stated in the filing that they believe the outcome is not expected to have a material adverse effect on their financial condition. So they're acknowledging them, but don't seem overly concerned about the financial impact right now.
Got it. What about the way people shop? The retail landscape seems to be changing pretty quickly, too.
Yeah, that's another factor, the continued growth of e-commerce, online shopping, but also things like online to offline shopping, click and collect, that kind of thing. Plus the increasing power of large retailers or buying groups, that definitely impacts the whole industry dynamic.
And internally, any big system changes happening?
Yes, they mentioned an ongoing migration to an enterprise resource planning or ERP system.
Ah, those big company-wide software platforms.
Exactly, integrating everything from finance to supply chain. That migration, along with the big 2019 productivity plan we discussed, is causing changes to their internal controls over financial reporting. They noted it, but also said it's not materially affecting the effectiveness of those controls at this point.
Okay, so let's try to wrap this up. To recap this deep dive into PepsiCo's latest quarterly report, we saw headline revenue looking pretty stable, almost flat year over year.
Right, the top line was steady.
But a really sharp contrast on the profit side.
Yeah.
A big drop, primarily driven by those significant brand impairments, specifically for Rockstar Energy and the Be & Cheery brand.
That was the main story, yeah. The $1.86 billion write-down.
Meanwhile, they're strategically acquiring new, potentially high-growth brands like C8 and Poppy, spending billions there.
Investing heavily in the future portfolio.
While also continuing this massive long-term productivity plan to streamline operations, and of course, navigating this complex web of global economic headwinds, FX, commodities, and regulatory pressures.
That sums it up pretty well. It paints a picture of a giant company in transition, dealing with legacy issues while betting big on the future.
And this information is crucial for you, the listener, whether you're prepping for a meeting, maybe just trying to stay current on the consumer goods industry, or like us, just intensely curious about what makes these huge companies tick.
Absolutely. It highlights the constant evolution needed, the challenges faced, even by the largest corporations. Nothing stays static.
It really does make you think. Here's a final thought to ponder. Given PepsiCo's substantial investment in these new up-and-coming brands like C8 and Poppy, right alongside the massive write-down of an established, albeit perhaps fading, brand like Rockstar, what does this really tell us about the shifting landscape of consumer preferences? And maybe more importantly, just how much agility does it show that even the largest food and beverage companies need today to stay relevant and ultimately profitable in the years ahead?
And that's the billion-dollar question, isn't it? How fast can they adapt? It'll be fascinating to watch.